Hi everyone, welcome back to the Hills Property Panel, joined by Dr. Andrew Wilson from My Housing Market.
G'day, Scott.
Thanks for coming. And Stu from Benson Auctions.
Good morning.
Like always, we'll be talking about the market influences and what we can expect to see over the next coming months. Dr. Andrew, we've got the new RBA governor in now.
Yes, she's had her first decision. Of course, we've had another pause, which is great news for mortgage holders and good news for the spring selling season as well.
How does the new structure look like?
We had a lot of discussion over the performance of the RBA earlier this year. The government's decided to change the structure. We now have a new governor, of course. The new structure is very similar to what they do in the US. They're only going to have the 8 meetings. And I think one of the interesting things is that the RBA governor will now have to front the media following every meeting. And I'm not sure whether it's appropriate to be, facing the media in such a delicate environment in terms of monetary policy.
What certainty do we have if we put
we don't.
back on?
Well, this is the problem, you see. So why put yourself in an environment where you have to answer from a media who will want to have specifics, and who are just waiting to hear, the headline, interest rates to fall, right? Or interest rates to rise, right? Yeah. It's just a field where accountability is very vague because of the whole nature of monetary policy. I don't understand why we can't have a monthly meeting, because things do change and we may have to change monetary policy if there's a left field event, which we're sort of seeing now with the price of oil starting to rise again. And that contributed to a rise in inflation, which was a surprise rise in inflation over August, which sort of set, I guess, a lot of pundits back on their hands because we expect it to continue to fall. But
we thought we were doing the right things to make it continue to fall.
Yeah, well, we're on the right road. Yes. Wait and see, pause. Oh, that's great. Well, it's great. But what happens if we've waited, we've seen, and nothing's happened? So we're not even halfway. We're about halfway to where we want to be in the target. And the RBA says, well, yeah, but we've got 2 years. We reckon that's when it'll get back. But we've got these issues now with oil rising again. Australia has a lot of issues with housing costs, rental costs, house building costs, which is pushing up inflation, which is going to be difficult to manage. And we've still got a roaring economy.
Right.
I mean, the latest unemployment data is spectacular. It is spectacular.
So we're in a good position?
We're in a great position.
Right.
We're
Sydney,
an unprecedented
country.
Great position. New South Wales, Sydney is the strongest, has the strongest economy by measure of unemployment in the country. It's got a lot to do with why its housing market is so vibrant. The national unemployment rate, 3.7% over August. But the amazing thing with the unemployment rate is that we created 63,000 extra jobs, which is massive. We had 3,000 fewer unemployed. And our participation rate rose to an all-time record high. Now, the participation rate measures the proportion of the potential workforce that's actually working. Now, we've now got the highest proportion we've ever had of the potential workforce actually in work. So look, it's a great economy. We haven't seen any real sign of a significant shift in inflation. Inflation has fallen because of the adjustment post-COVID to the supply constraints that we had with all the stimulus packages. That's the only reason why inflation has fallen, and cost of petrol has fallen until recently and now back up again. It has nothing to do, in my opinion, with interest rates. You could have probably left interest rates where they were and we'd still have the inflation rate where it is now.
You're saying that we're in a good position, New South Wales, Sydney-wide. Absolutely. Is that reflecting on the property market?
Oh, well, we've had a remarkable year this year. Sydney's median house price is now just a touch under 10% higher than where it was at the beginning of the year, and still rising.
There's still time for it to drop 20% though, surely. No. I thought that was this year, right?
I mean, I don't know how long it's going to take the egg to be scraped off the face of those that predicted massive falls this year. Again, deja vu.
We didn't. You can go back and watch the videos.
No. We were the first to say things were looking better.
Yeah.
And that was September last year. We said it here that things were starting to look better. And, maybe it was like, they would say that, wouldn't they? But look, here we are now. Yeah. The market has not only turned, but it's had a very positive year and just about caught up with all that it lost with the issues over higher interest rates. And now we've got to remember, 10% growth in the Sydney market this year, despite 12 increases in interest rates since May last year.
Yeah.
Most of the increase comes while we were still increasing interest rates through autumn and into early winter. Sydney just is undersupplied with property, but I think people recognise that it's, you know, the real bottom line here is I have to secure property in Sydney. It's just such a roll gold investment. And the cycles keep proving it. And here we go again. Strongest economy, strongest housing market now, and just about back to peak prices. And you know what I think is a good thing? That next year, all things being equal, and economists say that, I think we'll still get growth, but we're going to get a much more predictable growth cycle as long as everything else remains settled. And that, of course, means interest rates.
Well, we've had everything thrown at us to try and shake the property market from the trees, Stu. And the media's jumped on these items as well. Now, as you mentioned, been doing the panel for about a year now. Many things have happened in the economy and externally. Has that affected the property market?
Certainly not here in the Hills District. That great Australian intrinsic dream of property ownership, and that we've heard from our parents and their parents to invest in bricks and mortar, it's still one of the biggest driving forces of people saving, of people staying at home a little bit longer if they have to, doing whatever they can to get themselves onto this property ladder, into this property market, and doing so here in the Hills District. The amount of people that also aren't leaving our district either. They've grown up here and fell in love with it, be it the schools, the areas, the parks, the shops, the communities, and they're staying put. We're in an area where there's significantly high median house price, and these people are doing whatever they can to get in. Despite the interest rate rises, that desire and that want and that need to invest in bricks and mortar grew and grew and grew, and we are in a very strong market at the moment, and I think it just proves that, as a commodity, as an asset, and as a desirability, bricks and mortar here in the northwest of Sydney is continuing to prove a really solid investment. Clearance rate remains strong, and we're still undersupplied when it comes to stock.
I see. Is there plenty of people out at open homes looking around? We're talking about this is the lovely season to go out property shop.
It does add up to increased activity. Bidder numbers, however, aren't growing at the moment because they're spread across a broader base of listings.
We've had low stock for a long time. Maybe 2 years we've had low stock levels. So what is your opinion on what's happening? And how can that move? Will that shift?
I think a lot of people are actually staying. I'd love to actually probably go back and have a look at some of the data around tenure of ownership here in the Hills District. It feels like people are staying put a little bit longer. Their house might suit them a little bit longer if they renovate, or if they extend, or if they put a second story on, or the kids are going to stay home a little bit longer, so we'll stay a little bit longer. So it just feels like the turnover, which used to be that sort of 7 to 10 year turnover, we outgrew our property and we'd upgrade, and then we outgrew it, we'd upgrade. It seems to be, from most people I speak to, that length and tenure of ownership is extending. We inherently have a slowing down of the churn of stock. The only way that we're going to get more stock in the Hills District is if 20 owners decide to sell and a Château gets built. And that's the reality of it. I'm not spruiking the development, but unless we go up and we increase density, we're reliant on waiting for that churn and that turnover. And if that turnover is slowing down because people are staying in their dwellings longer, then we're forever going to be undersupplied.
The Hills District used to have a really high turnover of stock, most amount of sales across Sydney. That's why a lot of agents like selling here.
And that's
Castle Hill, Borkham Hills and around here.
And that's because of the nature of the demographic to a large degree, growing families, upwardly mobile. A lot of people are interested in the Hills because it offers a fundamentally different environment to most of the other Sydney region. We've had this period really since 2018 of these erratic cycles of housing cycles where we've had nothing happening, COVID, and then, through lockdowns, and then when COVID eased, you get no stock, and then you get a massive surge in stock. Now, you've got to remember, in 2021-22, we had record levels of properties coming into the market because we didn't have anything happening before that. So when you balance it out, we're actually at the end of that, sort of cyclical imbalances prices and waiting to sort of get back to a normalised position where, it's not being affected by these, erratic cycles of ups and downs that are caused by these, left field issues such as COVID or higher interest rates.
Yes, yeah.
People are either listening to the media to understand when to buy, Stu, or when to sell. Or they're out on the open home numbers and they're seeing what's actually happening in the marketplace. As in people are willing to pay that amount of money, or the lack of supply around there. What would the advice be to the homeowners that are listening to the media?
Look, I mean, we call it, in the industry, we call it social proof. Like if your local market is performing well, the clearance rate is high, properties are moving in a short period of time, they're selling for good prices, and each and every time you attend an open home or an auction, there are people walking around or holding bidder cards, your market's in good shape.
Right.
So you can open up a newspaper and a national masthead that is honing in on that one little soundbite of potential doom and gloom and take that as fear-mongering or scaremongering or have that affect your individual circumstance. But the reality is, if it's the right time for you to move or the right time for you to sell and your market is performing well, sit on the sideline at your own peril. The amount of people that I have seen sit on the sideline because some expert said the market's going to drop 20% over the next year, sit back. And that person, by waiting, has priced themselves out of their marketplace. The house that they should have bought has gone up 150 grand. They now can't afford it. They're now looking for school catchments and public transport routes on peripheral suburbs and areas that they don't really want to live in because they took the expert advice of a pundit who put a quote out there instead of just going and feeling the pulse of their local market. And a couple of weekends out on the grounds will show you what your local market's doing, be it here in the Hills District or anywhere else in Sydney. And I can summarise it by saying it's active, it's confident, and things are selling.
That's a really good point then. If anybody's thinking about downsizing, moving, buying, get out there and have a look to see what's happening. It'll only take you an hour or two on a Saturday.
100%. There is no better research than you can do than getting out on the grounds.
Yes.
And you will feel the pulse of what's going on in the market.
I see. And well, moving can take some time anyway. You might have to renovate, you might have to do the gardens and lawns. So if you're getting that all ready now, I mean, it's still going to stay good for you for another year. Get it all prepared.
An auctioneer is normally booked 5, 6, 7 weeks in advance. We're booked before the photographs are taken, the property is styled, staged, small renovations are done. I'm currently taking bookings for January and February 2024 already. There are people that have already conceded we're not going to get this ready this side of Christmas. We're going to get ourselves ready to launch in the new year. People are already planning. So
for next year.
And that's what buyers should be doing, getting out there right now, doing your research. If you've got to sell, get an idea of what your home's worth. But if you've got to buy in the same market, start doing your research, stop reading the papers, get a good finger on the pulse feel by getting out on the grounds.
Okay.
Yeah.
Stu, the market's performing well. This is what we're talking about.
Yep.
I'm seeing the signboards, sold stickers going up. The new stickers that I'm seeing is now sold off market. Tell me why.
Look, interesting. At the moment, you drive around the streets and you will see a few, not a lot, but more than we ever have had before, sold off market as a bit of a chest beat from an agent. I think it's a little bit weird at the moment if you're a property seller and you're not truly testing the market, truly creating competition, and truly opening your doors to everybody who is looking for a house at the moment. The Hills is undersupplied. Unless the circumstance called for it that you'd bought a property at auction, you needed to move your house really, really quickly. You needed to get it sold so that you could align settlements. Then I could see maybe just getting a database buyer through the property, getting it sold, getting it done, and moving on to the next. That would be pretty much my only reason that I could understand selling off market at the moment here in the northwest of Sydney, and particularly here in the Hills District. The demand, the numbers that we're seeing at open homes, the numbers of registered bidders, the numbers of bids per auction, and the clearance rate at the moment. Look, it's counterintuitive to what is going on in the current marketplace. We're undersupplied by any metric, any measure, any conversation that you have with any decent agent. To take a property to market is going to yield you a fantastic result.
Well, I'm not here to pick on anybody's business model. They can
do whatever they want.
To understand it, why is it delivered to you on the market, or what's the term that they're saying, offered to you, off the market, and it's on social media. and it's on, different platforms, but it's just not on Real Estate and Domain.
Yeah.
So is it really off the market? Or?
Not really. A lot of the time they're not really. It's still being promoted by social. It's still being promoted by Instagram. It's still getting out there. So it's not truly off the market. A true off the market sale does happen, and again, that could be circumstantial. That it's got to happen that way because that vendor has to sell in order to transact on another property. Right place, right time, right database buyer comes through the property, and the deal is just done. Was it the highest price in the market? That vendor will never know.
No.
And I'd imagine that agent's still getting paid the same commission that they would have got paid if they'd done 6 weeks worth of work. So not a bad deal for the agent, but I do think that at the moment, I would be testing the market. I would be offering the property to the market. It's not to say it won't sell in a week or 2 weeks, but at least in a week or 2 weeks, you would have had the full market, the full realestate.com.au buyer, the full domain.com.au buyer. Everybody who might be looking for a property can get through your front door.
Yeah, if you stick with that recipe of getting the open homes and all the numbers through the auctions and all those types of things, like that's still the best formula.
I'm not saying run to auction or run for 6 weeks or whatever it might be. You can get it done in 1 or 2 weeks, but you got to expose that property to the market,
the full market.
I just think it's a bizarre strategy at the moment. Sell pre-auction if you like to, and sell in 2 weeks unconditionally with a 66W certificate, not a problem at all. But at the moment, again, undersupply, and that's just not here in the Hills District. It's everywhere. We just do not have enough stock. And so it's sort of not really helping the whole problem of stock levels if we're selling stock off market.
Gotcha. Yeah. The last question would be about the retail sector and how the economy is performing in that division.
Well, we've got a number of indicators about the performance of the economy. We've spoken about the labour market, which is very important. It's called like the real economy. And of course, retail sales are important, and retail sales have been, a key indicator. They always are through the COVID period, because that was how governments decided, obviously, to work their way through the uncertainty of COVID, was to throw money at the consumer so they could go out and spend it and keep the wheels of industry turning over. And of course, it was hugely successful. And we saw an absolute surge in retail sales, which was the plan. Through 21 into 22. But the problem is that we didn't have, and this was a worldwide problem, was that we didn't have the supply to match all this demand. So inflation's gone through the roof because, higher costs reflected too much demand and not enough supply. But now we're seeing a settling of that because supply is caught up with demand. Post-COVID, it's all started to work its way into more of an orderly position. So our retail sales levels are easing. Now, our latest retail sales data for August was up by 0.2%. And the trend growth was 1.5%. Now, that's the trend growth between August last year and this year, which is actually a record low growth in retail sales over a 12-month period. Hello, we've just come from the biggest rise in retail sales in our history, right? And of course, we're going to see an easing in that. So it's all about the context. Now, if we look at retail sales at the moment, monthly they're working at around about $35 billion, right? Prior to COVID, they were about $26 billion. So we're 34% higher in 2 years in the level of what we're spending at the moment compared to then, which usually is a reasonably settled environment. Now, those that are saying, oh, this is bad news in retail sales, are saying because it doesn't even account for inflation, because obviously it's the value of retail sales that are measured. So when inflation's rising, as it is in the highest level of decades over the past year, that actually means that, the growth is about inflation as well as, actual increased volumes. The position we are in now, which is still massive. We're still spending massive amounts. We're just not growing at the same rate because we don't have the wheelbarrows of money being, gifted to us to do that, So it's still very, very strong. The actual volume of spending, it's not growing at the levels it did a year ago and past that, because we don't have all that money to spend, because we've spent it, which was what we were supposed to have done to keep our economy moving. And of course we have, the strongest economy in our history. And so it's sort of worked, Unfortunately, it's created inflation. So that's the bitter pill to swallow now, is we've got to control inflation, which will mean higher interest rates. But, those trying to talk the economy down on the basis of retail sales, I just don't buy it.
The wild thing is that these numbers are up in terms of the retail sector despite month after month after month of continual interest rate rises. So the money's there, the prosperity's there, people are out there spending. The economy seems to be in pretty good shape.
And look, the easing in retail sales, and it's an easing compared to where we were, which was through the roof, right? So we're not quite through the roof anymore, but we're still pretty close to it. Well, we're at record levels, so we are still going through the roof. But the savings ratio, which measures savings as a proportion of our income, has now fallen to a low level, but it's come from a massively high level because we saved during COVID. So we've spent all those savings, which is what the plan was, because we had to get that money circulating to keep the economy vibrant, and vibrant beyond belief at the moment. And, you know, it's perplexing for the RBA, because after having paused 5 out of 6 months interest rates, there is absolutely no sign that higher interest rates are doing the job they're supposed to do, which is quell demand. So, and Australia's housing costs, there's no sign of an easing there with rents and house building costs, and these will continue to work their way into the system. And as economists know, it's the last little bit of the inflation problem is the hardest to solve. That last little couple of percent, right? It's like, how do we get rid of that? And unfortunately, monetary policy is the key. Now, I don't know whether central banks, RBA, US, Fed, have maybe decided, look, it's maybe better to have higher inflation for longer than it is to crack the economy.
It seems like
I think that's what's occurring. Because they're, you know, and I maybe to some degree you can sympathise with that, because it's a very tough environment when you do get high and accelerating unemployment. You know, that really destroys lives. Now, I know inflation is bad too, and it's like, you know, it's the horns of a dilemma, this or that. And that's what I guess we're hopeful that the RBA will be able to make the right decision on that basis, you know, that they've got to find the balance. But at the moment, you know, I don't think we should be dismissive of what such a great economy we've got at the moment.
Thanks for coming in, Stu. Benson Auctions.
Pleasure.
And thanks for coming in, Dr. Andrew. My Housing Market.
Thank you very much, Scott.
Thank you.
It's great to be here.